Hi, everyone. Marty, thank you so much for the introduction. It is such a pleasure to be here, and we really have an amazing panel. Let me introduce, obviously, ladies first. Kendra Rommel is the principal and co-founder of the Futures Financial. Kendra, hi. It's so great to see you. Hi. Um, then Tom is with me on Zoom. Hello.
Hello there.
Hi, how are you?
Great.
Tom is the co-founder and general partner at Pivotal Capital. And then next to Kendra in the audience, I didn't bring my glasses. I'm just kidding. I know who you guys are. Okay. So we have Bill. Bill, I'm gonna butcher your last name right now. Is it Bymel or Bymel?
Bymel.
Bymel. Thank you. Founder and CEO of First Lien Capital. And next to him, Chen, managing partner at Kayne Capital. And we're going to build on what Marty just brought up about banks. And I know that everyone in the audience would like to know your opinion on whether the banking crisis is at its very beginning. Is it in the middle? Is it getting close to an end? Like, what is going on? What is the dynamic of it? And Kendra, I'm going to ask you that question first. Please. Please. Listen, I have a ladies first policy. You know what I mean? Ladies need to get a break from time to time. So Kendra, go ahead.
I mean, my personal opinion is probably very different than any VC money coming from the debt space and real estate space. But I believe that we're at the very beginning of the banking crisis, if you will. I don't really like that word, but the shift in banking.
Sure.
And
no doubt.
I mean, I could go off on a tangent as to what opportunities this is going to provide a lot of us, but
hold on to that thought. That's the next question. But Bill, do you want to jump in? I know you have a very strong opinion on that.
Strong opinions about everything, but
yeah. Good. We like that.
I actually happen to have some, some evidence that I think supports what Kendra is saying, that we're in the beginning of the crisis. For me, this feels like, SVB was like the Bear Stearns moment, and if you remember, if those of us that were aware back in 2008, it was another 6 months before markets really imploded and so some examples, I'd like to believe, I respect Jamie Dimon a ton, but his quote the other day was that this banking crisis is over. This part of the banking crisis is over. And I think the word is this, right? Because there are more skeletons in the closet, no doubt.
Mm-hmm.
Regional banks and credit unions are the largest holders of commercial real estate debt in the country, especially office buildings, which we've all been hearing about today. What used to be deemed the A+ best investment, this is why banks were giving big mortgages on office buildings, is now like the pariah of the industry. And if more banks had to mark-to-market assets like that, or assets like these low interest yield securities that they're holding, then probably 30% of the banking industry would go down tomorrow.
Wow.
And not to make it too good, a couple of other pieces of evidence. I share a loan. I buy seasoned whole loans. I don't originate whole mortgages, but I buy them primarily when they're in default or some stress, or the seller's in some stress. So I share a loan servicer with the NCUA. I had never even heard of the NCUA in being in business all my life, had never really heard of the NCUA until last year. NCUA is the FDIC for credit unions. There are over 30% of the credit unions in this country that are on the watch list right now. What is historically considered to be very conservative investment, conservative banking style in credit unions, people are caught with under the same issue. And there's no doubt that this is just the early stages.
Yeah, I'd share that sentiment. I think by definition, we're probably not at the start, given that there have been dominoes that have fallen. But with that being said,
Second or third inning.
you know, to add to your statistics, right, there's about $2 trillion of loan value, right, that is below market value.
Right.
That's not, or that's market values below their holding value. Half the banks right now have assets less than their liability. So if you look at that, I think a lot of the extremity of what's going to happen next is largely going to be driven by what, you know, the next Fed announcement any time now,
Right.
and their predictions for what comes after that. Because I think right now you have this counterbalance of inflation and preserving bank solvency.
Yeah.
And right now, unfortunately, it's a disparate dynamic of what to choose. And so until there is further clarity on that, I think there's going to be a lot of volatility that we're going to see in the market. And to your point, I think there are quite a number of companies that have scathed by for the last few months. And we've talked about this right when SVB happened, that, are we past the storm or are we in the eye of the storm? I think it's pretty clear that we were in the eye. And I think we're going to continue to see dynamic shift, especially as rates continue to increase.
Agreed. Tom, do you want to say something?
Yeah.
Well, I
Tom.
agree with all the colleagues on the panel. I think that, the recent failures were an inflection point for the entire regional banking system. And, we were very intimately close to this in Silicon Valley and on the East Coast with portfolio companies that were banking these companies. And I think, the days of easy deposits are over. I think that these banks are still the remaining regionals, interest rates rises are their biggest enemy. That's not going to ease anytime soon, even though people are thinking that it will start coming down after today's raise. But it puts tremendous pressure on them, and it's a crisis of confidence. So, just as an anecdotal point, we've instructed all of our portfolio companies that any uninsured deposits have to be in treasuries, or they have to be in sweep accounts diversified across larger banks. And so, we do that with our own fund. So. And that's a very small microcosm of the world, but I just don't think the confidence is there. And this is a confidence game, but also the financial pressures on the banks. They're getting it hit. They can pay a little higher rates, but that accelerates the problem, in my opinion.
It's interesting, Tom, you've mentioned the portfolio companies, because in many ways, wasn't it the portfolio companies coming that really caused the SVB situation?
It was like a 1920s bank run, and we heard inklings of it. It was very quiet at first, so the big money was moving out, and then everybody got wind of it. And with today's automated banking, it's so easy to transfer funds. The speed at which deposits were drawn out of Silicon Valley Bank, and the subsequent other regional banks, First Republic falling on that. But if you look at other regional banks, you still see this outflow of deposits. And it was the portfolio companies. And interestingly enough, I think the venture capitalists who were saying, stick with the bank, you don't go away, but they were also at the same time removing deposits from the banks. So
more evidence that I have to follow up to that point is I'm in the business of trying to buy distressed paper, buy paper from banks. It's like hounding, you're chasing constantly. In the last year, it's been a totally different story. I've never actually been reverse inquiry by banks. I've got banks coming to me for money, which is a little strange. I had a major bank, a loan originator owned by a major Northeast bank, that said their own bank has shut off funding for anything non-agency. So, that says a lot right there.
Yeah, I think
Bill, you're answering my question number 2.
Perfect.
And sorry to interrupt the flow, but I will pose the question so it's easier for the audience. So we're gonna get into discussing what are we seeing in terms of opportunities and deal flow, right, against this backdrop of what's going on with the banking system. And I want to come to Kendra because you started getting into it. I just want to make sure that you tell us what your thoughts are on that.
Well, I mean, obviously for each of us, it's very different. Me being on the debt side and in the investment space only, non-consumer, I would just say, I think the opportunity is now in whether you're a participant in a first trustee debt fund, which is going to facilitate a lot of money movement over the next, I'm going to be bold and put out a time frame, but I would say the next 12 to 24 months, in my opinion. I think that the opportunity of potential distressed property, even with the inflation or the appreciation in real estate over the last 3+ years, I think that you will see some distressed opportunity in a different form that we've seen it in the past. I think with paper trading, I think we're seeing a lot of opportunity there because of the market situation. I mean, banks are going to be forced when you lift the Komodo, like so much of these gentlemen up here have said, if we're really taking a good hard look and these other variables don't fall into place perfectly with government assistance stepping in, at some point, all of these things, as we've seen it trickle out, it will trickle out or it'll hit its ceiling. So I think that there's just a massive opportunity for investors with true liquidity and capital to deploy. I just feel like the opportunity is endless for the next 24, 36 months.
Yeah, I agree. I think, in the technology space where I live, particularly in the lower middle market, we already saw migration of capital moving away, one, from equity into credit, largely driven by market correction. What we saw, equity is no longer the cheap piece of paper that it once was 2 years ago. And at the same time, companies had raised at unprecedented valuations, making it that much harder to raise capital in this new environment. So in effect, the first step was this recorrection now where lower cost of capital, less dilutive solutions are far more attractive, at least for the entrepreneurs that in the world that I live. But on top of that, now then you have the compounding effect of commercial lenders and what's happening with them. And we built a thesis 2 years ago that said commercial lenders are not the best source of capital for lower to mid-market companies, particularly in the tech space. I think that continues to hold true, and now is further emphasized by the fact that they were showing, that their balance sheets cannot support this type of risk. This quick anecdotal barometer, we were going out on behalf of a few of our portfolio companies to recapitalize them back in Q3 and Q4 of last year. And the first question that these regional banks asked us about the companies was not their cash burn profile, their end markets, their exit opportunities, loan to value, whatever. It was, how many deposits can I get into our accounts, right?
Yeah.
So here's indicator of where their priorities were at that time. So yes, because of the fact that they were so heavily reliant upon deposits, they were able to offer a lower cost of capital solution. But obviously that has not, played out the way that they intended. And so private markets, I think, is where, in private credit in particular, is where a lot of the capital flow to, because the assumption that these regional banks will be acquired by the JP Morgans of the world and that business will be usual is just not going to be the case, Different mandates, the regulation that likely is going to come over the next couple of quarters or years will be highly impact their loan appetites. And so what that's going to mean is there's likely going to be a gap for a time, and then markets will correct. And I think where the correction will happen will be funds that have a lot more flexibility around how they deploy capital to fill that hole.
But before you jump in, really, you just hit on a couple points that I was trying to communicate, but you did a better job.
You got 3 words.
No, but I really think it just highlights, to your point, diversification in these private vehicles, where people see the value of movement outside of this institutional structure or confines, because we've seen these institutional or government-backed entities fall or leave us at the altar. And so it's creating the disbelief or the transparency rather of this is not a fail-safe. One of my favorite things to hear when we're out raising capital ourselves as an organization is, well, why would we invest in X if that we could get a treasury at 5%, Like, this is the number one thing that's spoken to us every single time we're out there raising capital. And I say, well, how much, my question to you is how much trust do you really put in our government? Why are we sitting across the table from one another? it's just a question, right? Like if you can get if whatever, fund vehicles are performing at darn near what a treasury is with slightly more risk, depending on how that fund structure is developed or created, why would you put your money all in the government? Why wouldn't you take a risk on yourself or your operators that you're choosing to partner with? Like, it's a far safer bet to me, because I've seen these largely backed government entities fall and or leave people at the altar, and businesses fall by the wayside, like these regional banks.
Marty's got a question.
And Kendra, can you, and actually it's kind of like hit me, can you kind of expand upon that? Because it seems like there's a lot of equity funds which are gonna have to really lift their game up to match what credit funds are doing right now. Like Tom is gonna have this fantastic performing, venture debt fund no matter what, because the circumstances are just right. And everybody else who's doing, treasuries plus 8 or 9 plus warrants, what does it say for equity funds that maybe have been returning 20%, but who cares? Because you guys are returning the same amount.
Tom would have to speak to the VC portion of that.
Let Tom jump.
Yeah, so just real quickly, we're seeing unprecedented demand, as you would expect. I mean, we live in a very small world of supplying capital in this space, and so rates are the best we've seen, and our terms are tighter. But as far as equity goes, I started seeing the pullback, 2 years ago as equity funds were pulling back, and then consequently, portfolio companies were worried about valuation and going out and getting additional equity. So that became attractive at that time, certainly in the later stage, high growth companies. But that was all accelerated into hyperspeed with the failure of the regional banks, which did a lot of that. And just for the deposits, certainly SVB is the prime example of that. So I think, equities aren't going to go away. They're obviously integral to our world, but we've already seen valuations from the outset just get back to what we consider normalized. And typically in the venture debt world, we do much better in markets like this, as you would expect. I've been through 2000, 2008, and some of the smaller ones in between, and this has the same hallmarks. So good companies get better, bad companies go away, and that's kind of where we come out in this type of situation.
The further to the fact that a ton of banks have done this thing where they tried to attract high net worth clients by giving them low interest loans. Those are the same loans that killed Signature last week, right?
Right.
There's a lot more out there. I know, because I'm being offered some of them to bid, and other banks that no one's not even on anyone's radar. It all shifted obviously about a year ago, when we've never seen a time in history where we've seen a 500, 600 basis point move this quickly. And when that happens, the back of the economy will break. I have even actually met with or been on panels with guys that are at the Fed, and it happens to be these were real estate guys at the Fed. And one of the things that they said to us 4 months ago was, Dominic Provenzzi says, it is very clear from the higher ups that, that real estate is going to be a casualty of what we have coming, and not the only casualty, but a casualty. And so the deals that we saw where it shifted a year ago was when low interest performing loans on the secondary market that were perfectly performing, new origination, 750 FICOs that were selling in the 60s of valuation, where they were selling less than the non-performing loans. And ever since then, we've started to see some trickles from the banks, 5-year-old, 3-year fixed arms that are now reset for 2 years. Borrowers are defaulting there. We're not as seeing a huge, it's not the oh shit phase yet. So,
would that be the middle or the end?
I think.
Is it really though? Is that really the middle?
Yeah, it's the beginning of the middle.
Cycle for a new group of investors to
I
step
think-
in.
Oh,
So
absolutely.
It's a reset.
It's a reset opportunity more than it's like, oh shit, and we're all in trouble. I just see these each as pivots to the next phase of the cycle and the reset. And so, look, anytime we're talking about any business structure, fund structure, capital stack, I think it's important to just take note that there is a backside, and depending on how that business is run, structured, or what have you, there is going to be potential legacy issues. It comes down to, do they have the liquidity or the bandwidth to support that?
Yeah, and on that point, to Marty's question, right, I think what happens with equity funds is, as a GP of both an equity and credit fund, you know, I can say, right, if you have capital deploy,
Yeah.
this environment is the time to deploy it. It might segue, I know, to our next topic, but you know, so valuations in effect are going to have to come down in
Right.
order for private equity firms to chase you,
Correct.
right? Their cost of capital is growing, right? Especially, we don't use leverage in our transactions, but if you're a bio firm, your cost of capital just doubled in the last year and a half. And so they're ultimately, that's gonna further drive down valuations on their key targets. But in effect, if their vintage for this year or next year is gonna look really great. Now, prior vintages, whether that's 2020, even some part of 22, that's going to be a much more challenging dynamic. But to your point on having to reset, I think,
Right.
you know, there's going to be a new wave of investors who are going to be able to pivot and change their strategies to a place where they can chase yield, and others which are going to have a much harder time, especially if they were overinvested and were mitigating risk, and those ones are going to struggle.
Correct.
So,
I was saying, oh shit phase, like that's a good thing for me. So, by the way, just that buyer, so.
Because it's not you saying it. So, Tom, did you want to add anything? Tom?
Oh, I'm sorry. No, I mean,
No, I'm just giving you an opportunity to jump in.
no, I appreciate it. No, I listen, this is, I get giddy with increases in interest rates. You know, our cost of leverage in our fund is fixed and very low because we're an SBIC licensed fund. So we get very attractive leverage that is permanent. It can't be pulled. So our spreads just continue to go up, and it's you know, this may be the landmark time for our industry. And I'm very optimistic about what we're doing.
Yeah, sure.
That's fabulous. Actually, why don't we go to our next question, which is, what is your strategy? Can you speak to us a little bit about exactly what you're doing, why it's the right time to do it right now? And I'm gonna go back to Kendra, because that's what I've been doing. I mean, I like my strategy. Kendra, go ahead.
Strategy, just as a whole, is just to move organically, slowly, and stay in our lane. And that's just slow, methodical growth of developing good product, and that's back end and front end. So we will raise the capital we want to raise patiently. And so that to us looks like structured, non-mark-to-market type money, people that we want to do business with. It's really just reinstilled our original value system, which to us was, we're not going to compromise for the sake of scaling. We're going to stay true to what we do. So pretty simple.
Fundamental.
Yeah. And grind it out as fast as we can.
yeah, sure, I can go next. You know, so part of Kayne Anderson, we are 32 billion under management, you know, focused on large markets, but with niche strategies. So I lead the growth capital group. We're focused on the lower middle market of technology. And when you think technology, this is not venture investing. This is not investing in startups where they don't have commercialization of product or even, you know, commercial product creation yet. You know, we're all about the stage of a company where they're at scale. And really our capital is kind of firepower to help accelerate that growth. So our companies are typically very resilient and cash flow efficient. And that strategy has existed since the inception of our funds. Arguably, we are better positioned today than we ever have been. Our strategy doesn't look particularly good in irrational times like 2020 and 21 when valuations are through the roof, because the companies that were being rewarded were the ones that were growth at all costs, irrational spending, and relying on future capital raises to be able to exit. Our strategy is almost completely the opposite of that. It's about pragmatic growth, entrepreneurs who have done this before, who appreciate the use of a dollar and a clear ROI towards how they invest their capital to continue accelerating their growth. And so for us, the strategy actually hasn't changed significantly. I think what we have done over the past couple of years, though, is remain very flexible in terms of the solution we can provide to our companies, especially now where companies are not necessarily looking for that cookie cutter clean equity deal that once was on the table a few years ago. They're going to need a lot more flexibilities from their investor base in order to survive whatever is coming at them for the next few years. So matching capital solutions with the opportunity is going to be very critical, and having a flexibility of, and so for example, we invest across equity, and that's structured equity to clean it, to common equity, but also across a continuum of credit products as well. And so providing that full suite of solutions to a technology company really allows us to put dollars to work where we see the best chance for yield.
Very nice.
Yeah.
Okay. I founded my firm, First Lien Capital, about 2 years ago, but I've got 15 years in the space buying defaulted mortgages. Mostly started at the GFC in 2008. Actually bought loans from Kendra back in the day, many years ago. So our strategy has morphed in terms of the nuances of it. Yet, so we're buying seasoned whole loans. We don't originate. We're only buying stuff that's preferred, anything we can buy at a discount to the face value of the debt, and at a very safe underlying LTV to the collateral it encumbers. And we've been able, at my prior firm and at this firm, even in rising times with no supply, very few defaults, we've been able to return mid-teens unlevered. So you can just imagine the excitement that I have going into the coming years, where we just have more products. The product's just increasing. We have more to choose from. We'll stay conservative. We've got, in 2 years, we've spent about 75 million of equity. We think we'll spend at least that much this year alone. The last time I agree with the general consensus that residential really, and we're buying a lot of single family home loans and condos all across America. I agree with the consensus that residential real estate isn't going to suffer, the way that it did 15 years ago. I think what we're going into is going to look more like the SNL RTC days than it did like GFC. So we're going to see a lot more of that effect on as far as real estate is concerned, certainly on the commercial side. But at the same time, a 1% increase in residential defaults is $120 billion of new paper. So for us looking out to go out and deploy 100-200 million this year in buying distressed paper or buying quality paper at a discount from a distressed seller, like a bank that's going out of business, then it's a very safe equity protected return, and I think the opportunities are endless this year.
So I'll just talk a little bit about our strategy. So again, a little bit different than you've heard up to this point, but we are a venture debt provider. We're senior secured lenders into the emerging growth stage companies. Every company that we do business with has to have strong equity backing. Our deals are structured as short duration, rapidly amortizing vehicles between 36 and 48 months. We get warrants on every transaction that we do. Given the rates and the increases that we have now, we're achieving what I think from this new fresh fund is certainly equity looking returns for debt. And if you look at historically, I think that in our industry, we have we shouldn't be called venture debt. We should just be called growth capital debt, because we don't have the binary risk that the equity investors do. So we make money even when the equity folks don't. And so this is really, as I keep saying, is really a great time. So we diversify across stage and sector. We follow good investors. We're agnostic as far as location. We do transactions in New York, California, and even now some in the Midwest. But the strategy is tried and true. If you look at the industry in general, our write-downs, our loss rates on a percentage of AUM, industries below 5. We have historically and are today below 1.5%, and getting, I think, really outsized returns. Unfortunately, we are capped by the SBA on our rates, that we cannot go above 14%. That's considered usury if we're also getting an equity kicker. And we're bumping up against that in all of the transactions that we've done out of this new fund, which we're deploying capital as we speak.
Let's check makes up for it.
We have a question from the audience. Does the state of the market bring life back to crypto? Who would like to take that one?
Next question.
Okay. All right. Should we open it up to Q&A? Does anyone have a question? Let me just, if not, we can continue, but anyone in the audience?
I got questions. Hold on.
Yeah.
Okay.
Hey, Tom, how big is your SBIC?
Right now, we have 75 million. And we're growing it. We just reopened the fund because we've had inbound interest from LPs. The majority of our investors have been banks, the larger banks from a CRA standpoint. They get Community Investment Act credits for that. But we also have a large inbound interest now from family offices. We've traditionally had family offices in our fund. I think it'll top out around 250. And that's a good size for us. I think when we get a little bit bigger, it becomes a chasing to try to get the volume on. I think in this environment, we could probably do a little bit more. But yeah, that's where we are and where we're going. And I just think that we got really, really good in our timing of launching another fund going into this cycle.
How big is the cap left by Silicon Valley Bank? I mean, they were like the 800 pounds.
Yeah. So literally 65-70% of the supply of what we do evaporated overnight. So people are scrambling in both venture funds and portfolio companies to find alternative sources, which are the private credit markets. And so we haven't seen a ton of new entrants into our space, which is surprising, but it's a hard space to get into. It's a hard one to really understand. It does not comply to the traditional underwriting methodologies that most people are used to. So you have to really kind of be part of the industry and have grown up in it. But yeah, it's a mixed feeling with the absence of these regional banks. I mean, they were great in service. We competed against them. We also cooperated with them. We did syndications with them. So it is a unprecedented landscape in the private venture debt market right now.
So could we say that there's no FOMO and that people are moving back to fundamentals again? I mean, is that what's going on with
Yeah. I mean, so yeah, it gets real simple. You really focus on the strong fundamentals, and the good news is that there are a lot of really good companies out there with tremendous enterprise value that are growing, and so it is sticking, as I heard someone say earlier, but we stay inside our box and we don't go outside of it, and we just keep. We're a business of singles and doubles, not home runs. And we just keep, doing this and building it out. So at the end of the day, our funds have typically provided 2.5x on cash and, high double-digit IRRs.
Great. So can everybody here talk about where their deal flow comes from? And also, can you talk about a deal that you just love? Like talk about a deal that came to you and you said, this is awesome. I'm going to do it. So why don't we start at the far end with Kendra?
Are we talking front end deal, like a true retail deal, or are we talking a capital deal?
It's a deal that you love. Doesn't matter.
I love all deals.
What you love the most.
Look, from a business development side, again, I stick with it. We're pretty conservative in that we stick to what we know. We like any ground up or value add proposition. We feel like that is a space that's underserved, misunderstood, and yet we understand it well and we know how to operate in it in a performing and non-performing aspect. So we love value add propositions. From a capital side, we love capital that is a true partnership, that is true private wealth. We try to steer clear of institutional capital and stay as liquid and fluid to your point earlier about being flexible, but having the flexibility with not just our back end partners, but our front end partners, keeping the framework of what we like to do, but having the flexibility to make business decisions and having the proper capital partners to do just that.
Go next. So the world that we live in, these are usually companies that are not necessarily using investment banks to market their solutions. It happened a bit during the peak, because there were so many capital providers willing to throw dollars at them, so they're always trying to maximize value. But with that being said, usually the good companies that are building something very important that don't necessarily need capital are the best investments. And so what we've done since the very beginning of our strategy was really build an infrastructure that can help find those opportunities. That was geographically moving out of Silicon Valley, New York, and Boston, and looking at areas like Toronto, Atlanta, Denver, Chicago, where they had really strong technology hubs, where they're really high quality technology communities, but we're just not given the same access to capital that Silicon Valley had just walking down the road. Secondly, we built very deep sector expertise. So we market map. We primarily focus on enterprise, B2B software or tech-enabled services. So we'll look at underlying dynamics, within supply chain, for example. And within supply chain, you might have last mile, first mile, warehousing, freight, and we'll identify all the key pain points, identify the opportunities of what companies are building solutions to fix those pain points, and then find the best opportunity within that. And then lastly, we built an operator network, which are experts in their own field. They might have been executives at Fortune 500 companies. They might have been ex-entrepreneurs that help us not only portfolio manage and help build value when we invest, but also help us think about the universe and where particularly those markets are going to be going. So those three things combined give us a very strong look, and especially in today's market, when no entrepreneur voluntarily is raising their hands to raise either equity or credit, having an opportunity to be able to know those companies. We're typically talking to them 1 to 2 years before they actually raise. So we're able to monitor their performance over quarters, if not sometimes longer, see them execute, and then come in and say, now's the right time. There might be M&A is a very hot topic right now, given where valuations are at.
I was just gonna say that.
Right now, with competitors that might have been, too expensive a year and a half ago when paper was cheap, might not have been on the table. Today, I think we're going to expect a lot of consolidation in this space. And if it's an opportunity for our companies to be the platform, that's very attractive, right? So opportunistic ways to raise capital like that, we want to be part of that conversation. Our team can help act as corporate development, and we're going to expect a lot of deal flow coming from that.
Any deals you love, Lien?
Yeah, I mean, again, we invest across all industries, but in the supply chain space, just to give you a flavor, we're talking to a company right now that helps utilize the empty space in airplanes. So they started mostly being an enterprise resource planning tool to help airlines manage all the different, usually B2B commerce that they're delivering in the bellies of planes. It's crazy. Major airlines are sometimes flying with 50 to 60% underutilized excess cargo space. And so the ability to tap into that, and now with the growing trend of e-com, being able to access those planes and they can act as a low-cost carrier as an alternative to UPS and FedEx. So the company we're looking at basically provides the software to help facilitate all that, and then works with couriers, first mile delivery sources to get packages delivered to the door.
Yeah, that's sweet.
I like that deal.
I actually have, so we had Kayne Capital speak maybe 5 years ago, and they did talk a lot about how they love investing in places where Silicon Valley and New York and Boston aren't. So, and one of the things I always took to heart was they said, you can go to some of these university towns like in North Carolina or in Texas or places like that, or other areas that have, mid-level growth opportunities in private equity, and you see that they have fantastic operators, just amazing operators who don't have capital. So kudos to you guys, because you've done a great job.
Yeah.
And I always consider Kayne to be like the anti-HIG, which sends out 10,000 postcards to people they're trying to lend money to. So
yeah, that strategy doesn't work anymore.
Yeah, that's a tough approach. So Bill.
So as far as deal flow is concerned, the first 6 years of in this business, 09 to 15, 16, it was banks were dumping stuff, after GFC. Then it became 6 years of buying from larger funds. And my fund started buying from bigger competitors in the space, well-known mega funds, billion-dollar mega funds that had bought billions of NPL back in 15 that were winding down stuff. So my first year was buying from private equity. That was 2021. Last year, I've started to buy, the banks have started to sell again. First time in, almost a decade now since the banks have started releasing paper to the market. And so what I like, some of the two deals that I like, one is I kind of alluded to just a few minutes ago, was there's 5-year-old originations. Imagine a 20, can I do my math? 2018 origination. There's a 3-year fixed arm loan. So these were given, there's this one bank in the Northeast gave these 50 LTV, 60 LTV, 3-year arms to high net worth borrowers in California and New York. And so low LTV, they were like 3 3/4, 4% rates to begin with. Well, cut to 3 years later, and what's happened in the last 2 years since, these rates are now upward, getting north of 8. These borrowers are starting to default. The bank doesn't know what to do with them. So that stuff traded at a discount, and it's 8% mortgages. One of the challenges we had in this recent environment was when you get a 3% mortgage that defaults, there's no modification options. There's no way you can come in and be the good guy. A lot of our business was predicated on the idea that we were going to buy these 8%, 7-8% mortgages from pre-GFC. We'd come in and we'd lower the interest rate to 5%, keep people in their homes, which we did on 30% of our deals, and resell the paper. So that's why the move upwards in interest rates kind of kills that. The other second deal that I love was a deal we bought in October of last year, right when the NPL market, non-performing, subperforming loans, is a chunky investment market. You get waves of, because it's not cash flowing. So another private equity competitor of ours came to us looking to wind down one of their 7-year-old funds. They had a bunch of old Citibank HELOC mortgages, 15 years of seasoning, all sub 100,000, unsecuritizable paper. There was missing docs or, it's low balance. And we were able to buy, it was like a 9% average coupon in the portfolio. And we were able to buy that at almost a 30% discount. So and what it did was it gave a backstop to my portfolio. I bought a performing portfolio with 15 years of seasoning, a nice $30 million spend. That's nice mid-teens cash flow return. And that was the deal I loved last year.
When you buy these portfolios and they don't perform, are there clawbacks involved? Like, can you sell them back to the person who sold them to you, or?
No, because I'm buying them at a discount, no.
Okay.
If I was if you were an aggregator buying loans off of an origination line, those are the kind of people that would have clawback deals.
Sure. We got about 5 more minutes left. Tom, do you want to talk about?
Real quickly, we're one deal that I love, which just closed on, and we're in the center of technology and innovation. So this is AI everybody's talking about. We hear about all the really dangerous aspects of AI, but this company is using AI to automate and increase the success rate of in vitro fertilization. And I love it because it's a great group of entrepreneurs, repeat entrepreneurs that are glow in the dark smart. They have had multiple exits. They just raised 60 million in cash. The company's already doing 10 million in revenue on projection to do 20. And, it makes absolute sense for them and for us to layer in a tranche of debt at the senior level to get them to these next inflection points. But so it's representative of the companies we're seeing now that actually have meaningful revenue, that the good companies are still getting equity dollars, right? And so they're not overvalued. The valuations, we got in at the Series A on our warrant. So we got a great warrant position. I mean, I think that the right now, just out of the box, it's kind of a 13% yielding deal, which will go up. And I think the warrants will be worth a lot, but a lot of meat on the bones, a lot of enterprise value. And at the end of the day, not that this is part of our underwriting criteria, it is really, and this has happened to us in the past, where we're really being involved with companies that have the potential to really change people's lives. And this is certainly one of them. They can increase the success rate in IVF by another 50% over the traditional ways of doing it, which is pretty antiquated. And they also reduce the cost. So the reason why this guy started this company was he had a friend who went bankrupt through the IVF process and was not successful. So there's got to be a better way. So it's this nexus of technology and a problem that we constantly see the last 30 years we see happening in Silicon Valley. So I love this deal. I think it's great. It's a great yield for us. And I think it's going to be a real barn burner.
So food for thought, we had two women, because we actually had, I think we have a firm that's partnering with the firm you're talking about, because they sold some AI technology to a firm.
Okay.
We're talking about. These two women had been through 50 IVFs between them.
Yeah.
I think is it $20,000 per treatment?
25 to 30 on average. And, the eggs are the precious commodities, obviously. So what this company does is they, through AI, not to get too graphic with everybody, but they can pinpoint and pick out the best sperm available and take that one sperm and fertilize the egg. And it's very complicated. It's robotics, it's AI driven. But if you can take that success rate up and the cost down, it's life-changing for people. And that's a market that's not going to be affected by the economy.
How did we get from banks to this? This is a great panel, I have to say.
Sorry. Yeah.
That's okay.
We also have a question from the audience online. So Gary, you want to ask your question?
Yeah. So guys, no doubt you've heard yesterday's research by Hindenburg on Carl Icahn. He's got a lot of private investments. He marks them whatever the way they want. I've got some, opportunity zones, which is like 10 years, things. Who knows what's going on? 10 years ago, I was 10 years younger, right? So was Marty. So when I look at all of your stuff there, we really don't know what the value of those are. And some of them have 3-month or 6-month, notices, like Alan Schneider, who's going to talk about next time in some of his other investments. Others have gating. So my question really is, since you really don't know what the values are, other than you guys telling us, what do you think an appropriate amount of allocation you should put in a portfolio to any one and maybe all in total makes sense for those investments?
Yeah, we can't hear you. Can't hear you too well.
Group. Got a question in the audience? Will?
Yeah, for Tom, just the warrant coverage that you're seeing as the market changes. Is it warrant coverage going up? Is it changing?
Tom, what's your warrant coverage looking like? And are there restrictions on it?
So no, the warrant coverage is it's a negotiated process. We take a percentage of the loan that we're doing. So, historically, in times that we're not as good as like this, you'd be lucky to get 7 or 8. We're getting 10 to 12% coverage on the loan amount right now. And it's at the valuation of the company when we do the deal. We have anti-dilution in that. So we have, in every one of our transactions, the warrant life is 10 years. So we have a lot of optionality on that as it goes forward, but there's no pushback now. And we're actually kind of starting to push up the limits on the percentage of warrants that we can get in every transaction.
Tom, are you marking all your investments to market, like in terms of the?
Yes.
Right. Okay. And what is that right now? Are we talking about 50% discounts?
Easily. Yep.
Interesting.
Can I just?
Last comment?
I just want to go back to Gary because I don't want to completely step over what you were asking, Gary, because, I think there are red flags when you go to certain fund managers and there's a lack of transparency and door backstops or, limitations. You saw this thing with Blackstone limiting the BREIT, redemptions. One of the things I would look for in what we do to try to alleviate that concern is have a third party quarterly valuation of the portfolio to confirm our marks, so that we're always marking to market very conservatively, even though it's a non-liquid asset that we're buying, mortgages. So we have third party, we have audits, we, full audits and full transparency for any of our investors to look at the portfolio. And I think
I would agree with that. I
Same.
think, the third party validation is really important. I think also looking at the history of markdowns, that depending on subsector that a fund or a investment manager might have will also be indicative, because we live in the world of technology, right? You can see what the S&P did. You can look at peer groups. If someone hasn't marked down their portfolio, it must be for a very good reason.
Right.
Now we've had the benefit because we structure a lot of our equity, at least out of our current fund. As a result, our markdowns have been less than 5% on our third fund, and actually is up in our fourth fund. That's because of the types of profiles of companies we have and what have you. Now on the allocation front, that's obviously very subjective, because that can apply to anyone's risk tolerance. But I think the point that was made is alternative credit right now is generating significantly higher yields than they have previously, and starting to get to the levels of equity. And where you draw the line between credit and equity starts getting very broad, right? Because lots of different forms of debt and lots of different forms of equity can have very different return profiles. But thinking about it more as an allocation of yield relative to risk, I think that yield right now has a significantly higher upside potential commensurate with the amount of risk that one needs to take. So if for example, we're marketing our credit opportunities as yielding somewhere between 16 and 18%. So in that world, that is slightly lower than equity, but far beyond the historical average.
Fantastic. Well, great job, guys. Thanks so much.